Good morning to everyone, and thanks again for joining us for Tecnoglass quarterly call. It was another record quarter in all financial metrics, record revenues, gross margins, operating margins, net income, EPS, cash flow. So all in all, we are very pleased with the results and the evolution of the business. Starting out with our backlog, this is something that is very encouraging because the way that this year worked out is that single family residential basically carried the load. But now what we're seeing is that the backlog is growing in a very healthy manner, 7% year over year. And that's very much in line with what we're seeing from a macro perspective. Essentially, if we look at ABI or Dodge data, all the indicators are very positive. So we are seeing that on the ground, and we expect, the following couple of years to be very strong on commercial. And within commercial, it's important to remember that a lot of the exposure is to really the family sector, right? The multifamily and the single family already in production. Almost 2/3 of what we do is related to family construction, not necessarily to hotels or anything like that. So we're really exposed to the segments that are outperforming some of the other more challenged ones. And finally, in relation to the backlog, it's important to also know that it's understated because it's not fully capturing everything that we're going to be doing on single family residential, given the fact that that is very spot in nature. So very positive tendency. What we're looking for 22 and on going forward, and the commercial construction making a strong comeback is very encouraging. Going back to single family residential, this is really the highlight of the quarter, and for most of the year is really been the main driver of growth. That segment grew 213% year over year, which is a steep acceleration even from a record quarter in Q2 to Q3. And we continue to see very strong momentum in that front. Not only our legacy products, Elite and Prestige, are performing very well through expansion of dealers and distributors, but also our Multi-Max product, which is designed for home builders and tract homes, is ramping up nicely. So a lot of upside that we see going forward will not only come from further expansion and market share gains, but also from the introduction of the Multi-Max growing on a standalone basis as well. One thing that we wanted to highlight again, and we've done this throughout the year, are really, the factors and the competitive advantages that are positioning Tecnoglass for growth and significant outperformance versus our peers. And really, if you look at the factors that are having an operational and financial impact in the industry, Tecnoglass has really been shielded from that. We have not been exposed to this terrible inflation that everybody else is seeing on raw materials. We're probably the only company that is fully vertically integrated, taking into account our joint venture with Saint-Gobain to provide raw glass. So we're in a very good position because we control, 60-70% of our raw materials we do in-house. We don't rely on long supply chains. We don't import anything out of Asia. So we have not had any impacts as it relates to lead times, and that's been a tremendous advantage throughout this whole time. Our lead times continue to be at 8 weeks, in line with pre-COVID levels. So that's proven to be a tremendous advantage as to how we are able to continue capturing market share. On other fronts, transportation, for instance, we continue to have the trade imbalance between Colombia and the US. And we're basically not having any issues with ports being jammed or containers not being available. We're just in a different situation because there's way more containers coming into Colombia than there are going out to the US. On the energy front, we co-generate. We have solar panels put in place. So a lot of the energy we basically generate ourselves. We're not exposed to significant inflation in energy prices. And finally, labor cost. There's ample labor. Unemployment rate is about 12% right now. Wages are stable, so we're not encountering these same roadblocks that a lot of our peers are encountering, and that's helping quite a bit in how our business is evolving. We also wanted to introduce the concept of ESG. We're very focused on developing a strong ESG platform and strategy. There's a lot of things that we're doing. We're putting out our sustainability report for the last 4 or 5 years, and we're going to start developing metrics that we can measure on a periodic basis and make sure that we're aligned with best practices and whatnot. So more to come. We wanted to just highlight that we are working on that as many of the companies in the world are, but we are already advanced in what we're doing, in the products that we supply, in how we operate, how we save energy in our process. So many different things that we're gonna be highlighting as we move forward into 2022. On a financial, kind of honing in into the financial metrics, revenues were up 26% year over year. Obviously, the U.S. driving all of that growth, and within the U.S., single-family residential. So very strong growth. We also had a record adjusted EBITDA where we grew 40%. The adjusted EBITDA was driven by operating leverage, was driven by efficiencies. If you look at SG&A, we basically had a flattish SG&A versus obviously 26% higher revenues. So at the end of the day, record metrics, throughout. Operating margin at 23%, EPS 44 cents, significantly higher than what we did last year, higher than the 41 cents that we did last quarter. So everything is flowing through the P&L, including obviously our lower debt cost. We have refinanced our debt last year, and obviously that is showing up on our P&L with much lower interest expenses, and obviously a lot more flexibility, given that because of our cash flow generation, we have our committed line fully untapped. So all in all, a lot of financial flexibility, and obviously with the cash in hand, even after paying $30 million of that debt last quarter. So finally, on our outlook, based on everything that's going on and what we're seeing even into October, November, we're raising guidance again for the third time this year. We're now expecting revenues to get to 485 to 495 million. The higher end of the last range was 475, so we're actually moving out of the last range. And adjusted EBITDA, we're increasing to 140 to 145 range, which again is outside the previous range, which was between 125 and 135. And that's almost a 50% growth year over year, which is very impressive. So with that, we'll leave you. Hopefully, you'll join us for the next call at year end, and happy to discuss the results with you. Thank you, and thanks for the support.